okay, this is really awesome. Well, everything we're talking about today can be done through your self-directed IRA, or through your IRA at all. And John came in from Equity Trust. We can do options through your IRA.
Yes.
So your last name is
Bowens with an S at the
Bowens.
end, yeah.
Bowens, okay? And John is with Equity Trust. That's who I have my IRA through. And I love doing self-directed deals. Like, you guys can do options through your IRA. So you can do the link options and you can do sandwich lease options through your IRA. One of the special reports that come with my course is called Investing in Options with IRAs. It was written by the founder of Equity Trust, Dick Desich, and it talks about how to do options in your IRA. So it's kind of cool. So anyways, John, did you drive? You flew down.
I flew, yes, from Cleveland, Ohio. Happy to be here in Orlando.
You got a few.
Yeah, Cleveland, right? We have some Cleveland fans here. Yeah, I told them before. I said, "You guys didn't come here to learn, right? You came here for the weather and for the tax write-off, right?" No, I'm just kidding.
So anyways, okay, what are we passing out? We got something for Equity Trust, right? Tell us what that is.
Yes. Okay. So everyone who's here this weekend, we have just over 7 hours of education that we're sending out. So sometime throughout the course of the weekend, please fill that out and hand it back to me. I have a booth outside, so if you want to drop it by, if I'm busy, feel free to do that. There's actually 7 learning modules, and the first one you'll see there, it's the snapshot of self-directed investing, and it's just over. There's one module on there. It's just over an hour with, in fact, Dick's son, Jeff Desich, who's the CEO of Equity Trust Company. He's going to talk about the 7 tax-exempt accounts. So these are the accounts afforded to us by the federal government that allow us to put a lot of money into it on an annual basis, and in some instances, even from our real estate business, and get a tax deduction. And then we can take those monies and we can deploy it investing in single-family homes, buy, fix and hold, buy, fix and flip, and also lease options. And I know we'll probably get into that as well throughout our conversation. But this education is so that after this weekend, you can dive down a little bit deeper into the concepts that we're talking about. And I don't have time to go through, all of the different account types and all of the nuances of self-directed IRA investing. So we're just going to kind of give you a little bit of a preamble here, I think. And then following this weekend, if you want to participate in some additional education, feel free to fill that out and hand it back in to me. And then, of course, if you have any questions throughout the weekend, I'll be here until late Sunday afternoon. So I'd be more than happy to sit down and chat. So.
Cool. And so basically, if you already have an IRA set up, or if you don't, even if you already have one set up, you can move some or all of your money to Equity Trust, and you can open up a self-directed IRA through John. And then what they can do is then you can buy real estate through it. So the things that we're talking about this weekend, let's say you want to do a link option and you find an option that you want to flip. You can buy an option in your IRA, and then you can flip it. And so that all that money that comes in there, all that profit, that option fee that comes back, can stay in that IRA for you. If it's in your Roth, of course, tax-free for life. If it's not in your Roth, it's still in your IRA, it's deferred, versus, giving Uncle Sam that money right now. So.
Right. And to elaborate that, and what she's talking about is if you have an IRA, 401k, or any other retirement account for that matter, you can self-direct that account. Now, with the current financial institution that it might be currently at, they're probably not going to allow you to buy and sell real estate. There's only a few of us out there that are actually allowing people and empowering people to go out and actually use their IRA, 401k, and other retirement money to buy and sell real estate. In fact, that's our core competency at Equity Trust Company. When you come to Equity Trust Company, if you told me, John, I want to invest in, this index mutual fund and I want to invest in this target date mutual fund, I would tell you, sorry, I can't help you and I can't provide that type of advice. And that's because well over 99% of our customers aren't investing in those types of assets. They're investing in real estate. And we have just over 130,000 customers, and we custody over $12 billion in assets. And over $11 billion of that $12 billion is real estate-related investments. That's individual properties as well as loans secured by properties. So not only can you go out into your marketplace and buy and sell real estate, whether it's on an option or if it's a wholesale, whether you're buying on land contract, selling on land contract, anything that Wendy is talking about this weekend is conducive for an IRA environment. Anything that you've done in the past or you're aspiring to do, you can do inside of a self-directed IRA account. And to Wendy's point, if you buy and sell with your IRA, 401k, or any other investment account, you avoid paying ordinary income or long-term or short-term capital gains tax. And that's really the overarching benefit, if you will, of everything that I'm talking about and everything that our firm does, is allowing you to invest in assets that are not correlated to the traditional stock market, invest in assets that are indexed to inflation, and then most importantly, be able to do it 100% tax-free. Now, Wendy had mentioned tax-deferred and tax-free. So there's two different types of accounts. There's what we call a tax-deferred account and then a tax-free account. And you probably have heard the term Roth IRA, correct? Most of you have heard the term Roth IRA. And that really has become the preferred investment vehicle amongst real estate entrepreneurs and investors. But I will tell you that just over 66% of all IRAs are actually tax-deferred traditional IRAs. And that's because the Roth IRA didn't come about until 1997, 1998-ish, when Congress actually enacted the legislation. Age demographically, it's the younger generations that have the Roth IRAs, not the older generations. The reason why I'm telling you this is because if you don't have a Roth IRA or a tax-free account, but you have 401ks, you have pension plans, maybe a thrift savings plan if you're a government worker, or you have any other tax-deferred funds, you can roll those over into a traditional IRA, and you can invest using that traditional IRA into real estate, whether it's through an option or you're actually taking title to a property or lending secured by real estate, the same as if you were to use the Roth IRA account. Okay, so all of the accounts that Equity Trust offers, and any account that a self-directed IRA custodian offers, is going to be self-directed, which means you are going to provide the direction to your custodian, such as Equity Trust Company, to move the funds out of the account, sent to the title company or to whoever you're investing with. And then once the deal is completed and once we flip over to the revenue side, once you have lease payments coming back to the IRA, or if you sell the property for a significant gain, all of that money goes back into the IRA and it accumulates tax-deferred or tax-free. The important thing to understand is in each incremental year, you avoid paying ordinary income or long-term or short-term capital gains tax on all of your investment returns. So the Roth IRA is a tax-free IRA, which means when you put money into the account, you do not get a tax deduction for it. But you can grow it tax-free and you'll never pay taxes on any of the withdrawals, so as long as you're taking them out after the age of 59 and a half, which is the retirement age per the federal government. Now compare that to a traditional IRA, tax-deferred IRA, again, your 401ks, your 403bs, your thrift savings plans, your defined benefit plans, or as most of us know these referred to as a pension plan. These are tax deferred, so these are rolled over into a traditional IRA. Now you still have that same benefit in each incremental year. When you're buying and selling real estate, all of the income that you accumulate grows tax deferred, so you're not paying ordinary income or capital gains tax in each incremental year. But then when you take the money out after 59 and a half, if you choose to do that, you're going to pay taxes at that time. Now that might make sense to you. And the thinking behind the federal government back in 1974 when they created all this legislation, which gave birth to IRAs, 401ks, and various other retirement accounts, was allow Americans to put money into an account in their higher income years so they can get a deduction, and then defer that to when they're older, and hopefully they don't have as high of income, therefore a lower effective tax rate. Now, unfortunately, that does not work for most of the real estate investors that we work with. Now, for the other 98% of Americans, might make sense. But for most of the real estate entrepreneurs, investors that I work with, they anticipate having still some high income or some years in their retirement where they're going to have high income. So they want to put all of that money into a Roth IRA, which they don't get a deduction for. But again, the benefit is they can grow it 100% tax-free and will never pay taxes again. They can also take it out even prior to 59 and a half to use it for higher educational expenses. So you can take the money out and pay for your child for tuition, general fees, transportation, things of that nature. Or if you want to go back to graduate school or any other type of higher educational expense, you can take the money out tax-free.
For the education IRA?
Yes, yeah.
For your grandchildren or your children. So if you don't need the money now for doing these options, some of you don't need that cash flow or that income today, but you do need it for your retirement, and that might be your big why or why you're in here to learn how to do this. definitely consider setting it up either for your education funds, for your children, your grandchildren, or for your retirement. I mean, this is a really cool way to do it. So,
Yeah.
so I wanted to have John here just to make sure that, if you guys hadn't already set this up, one of the things too is, how about the income restrictions or requirements to actually set up or contribute to a Roth IRA? Is that still around, or are there ways around that? Talk to us about that.
There is. So with a Roth IRA account, unfortunately, the federal government tells us if we make too much money, we can't put money into the account. Okay, again, that's a tax-free IRA.
Isn't that lovely?
If-
You make too much money, so you can't
Right.
plan for retirement,
Right.
even though you don't get a tax deduction for it.
Exactly. Well, that happens as well with your traditional IRAs. But with a Roth IRA account, if you're married filing jointly, and if you make over $181,000 modified adjusted gross income, but less than $191,000 modified adjusted gross income, you only qualify for a partial contribution to a Roth IRA. If you make over $191,000 MAGI, married filing jointly, you can't put money into a Roth IRA. But there's a tax loophole that came about in 2010, which allowed all income earners to contribute to a traditional IRA and convert to a Roth IRA. Or if you have pre-existing traditional IRAs or tax-deferred funds like 401ks, you can convert them over to the Roth IRA account. And that's a big initiative for the federal government, because think about it. When you move funds from a tax-deferred account to a tax-free account, what happens? Pay the taxes. If I take $100,000 in my 401k and I convert it over to the Roth IRA, $100,000 is going to be added to my ordinary income. Now, I'm going to pay a lot of money in taxes, but I'm paying taxes on the seed instead of paying taxes on the crop. If I grow that to $1 million and I want to take $1 million out at the age of 60, I don't pay a single dime in taxes on that. So that's why people are doing that. But again, the important thing to understand is regardless of your income, regardless of your situation, you qualify for a Roth IRA. We just got to speak with you individually and figure out what your situation is, if you're over that MAGI limit or if you think you're approaching that MAGI limit. And we just simply put the money into a traditional for you, convert over to a Roth. From a tax standpoint, you're just adding additional item on your 1040 when you file your return. Made a contribution for $5,500, converted it over to the Roth IRA account. And as far as contributing to IRAs, you do have to have earned income. Okay, so what is earned income? Earned income essentially is income that you've paid federal, state if applicable, and local income taxes, right? You've paid your income taxes and your payroll taxes, Social Security and Medicare. That's earned income. Unfortunately, rental income, dividends, royalties, that's passive income. So you have to have earned income to then contribute to a Roth or traditional IRA. As far as contribution limits are concerned, you can put up to $5,500 per year when you're under 50. When you're 50 and older, they give you a $1,000 catch-up provision. That brings you to $6,500. And if you have a non-working spouse, okay, so they don't have earned income, but you have earned income, you can contribute to their plan for them. Now, there's 7 tax-exempt tools, if you will, afforded to us by the federal government. Equity Trust offers them. Just about any financial institution can offer this plan. Now, again, as far as how to invest the money, that's going to depend on your custodian or administrator and whether they're going to allow you to do these things. But as far as the accounts are concerned, there's the traditional IRA and the Roth IRA, which we talked about, tax-deferred and tax-free. Roth IRA, for obvious reasons, is the preferred investment vehicle, as I mentioned, because it grows 100% tax-free, and it has some benefits as far as education is concerned. And then there are some small business plans. There's a SEP IRA, a simple IRA, and a solo 401k. Just out of curiosity, by show of hands, who has heard of a solo 401k or an individual 401k? Okay, more than most. Good job. That's impressive, because this plan didn't come about until 2002, and then the Roth feature didn't come about until 2006. Most of the time, I get maybe one hand in a group of this size.
We got a smart group.
Right. Well, that does indicate sophistication, and that's something that we look for. And so with this solo 401k, if you have a small business and you have earned income through that small business, and you don't have to be incorporated. Maybe you're a real estate broker, you're self-employed, you're not incorporated. Maybe you're thinking about eventually incorporating. Doesn't necessarily make a difference. You qualify for a solo 401k, so as long as you have self-employment income. And you can put upwards of $52,000 into this plan per year and get a $52,000 tax deduction. Or maybe you don't want the deduction and you want to put $17,500 into the Roth. You wouldn't get a deduction, but now you can take that $17,500 and grow it 100% tax-free. So if you're looking at a Roth IRA and saying, well, I can only put $5,500 in per year, what am I going to do with $5,500? Well, you can do a lot. when you start implementing some of these strategies, optioning properties, wholesaling properties, et cetera, et cetera. But if you're really trying to increase your buying power and your bandwidth within those accounts, fund a solo 401k, get to 17.5. When you're 50 and over, you can actually put 23,000 into the Roth portion. That didn't come about until 2006. A lot of people aren't talking about these account types, but they're extremely powerful, especially for small business entrepreneurs. So now you can take that money in conjunction with your Roth IRA. Wendy had mentioned an educational savings account. We also offer a health savings account if you have a high deductible health plan. So you can even start growing wealth within your health savings accounts as well as your IRAs, your educational savings accounts. I have a client at Equity Trust. His name's Stan Brady. Wendy, you might have met Stan before. And he buys properties really now all over the country. But he's in the Cleveland market now, and he has over 14 self-directed IRAs at Equity Trust Company amongst himself and his family members. On one deal in Atlanta, Georgia, he bought a buy and rehab home for close to $100,000 using 8 IRA accounts. He used his traditional IRA, his wife's traditional IRA. He used his Roth IRA and his wife's Roth IRA. And then he has 2 daughters that are now 16 and 17. He used their Roth IRAs and their covered education savings account. 8 IRAs in aggregate went in and bought this property, fixed it up in less than 6 months, sold it for nearly $100,000 profit. All of those profits went back to the IRA accounts. Now, Stan really got involved with self-directed IRAs a number of years ago when he got married, and he got married to someone who had very high income. Therefore, all of his real estate business activities had a significant amount of tax that he owed at the end of the year. So he said, how can I shelter income given my situation? So he started putting a lot of money into these IRAs. He started doing a lot of deals in these IRA accounts. And when he first started doing these deals, he didn't have enough money to go out and buy and rehab homes. For instance, when he set up his daughter's covered education savings account for the first time, put $2,000 into the account. He couldn't go out and buy, fix, and sell or buy, fix, and rent. He went out and optioned a property. In fact, he optioned a property in Atlanta, Georgia. The consideration was $100. So he went to the seller, and this was a property. I have a PowerPoint, in fact, with some pictures, and when you would see this property, you would know that it was going to be a teardown. But he put the property under contract for I can't remember what the amount was, but the contract stated that the is it the optionor? Is that the right terminology I would use? The optionor?
Was him?
It was his daughter's CISA account. Am I using the term optionor, right?
Was he the seller?
He's the buyer.
He's optionee.
He's the optionee. Okay, so his daughter's CISA account was the optionee on this contract. So the contract stated, which Equity Trust received, Equity Trust Company, custodian, FBO is in for benefit of, his daughter's name, CISA account, as the optionee. He had the right to buy this property at a future date or assign to an investor buyer. With $100, he went to the seller, got the check from Equity Trust Company after sending us the purchase contract, and then he assigned that contract to an investor buyer in less than 60 days, and he had a check for $4,098.20 returned to the IRA, or the CISA account in this case, tax-free. So to put some of what we're talking, or that Wendy's talking about, unfortunately I got here a little bit late today, but in buying and selling properties on option, that is a very conducive investment opportunity for self-directed IRAs, especially if you have a small amount of money in your IRA account. I find oftentimes clients feel excluded from this conversation because they only have a small amount of money in their IRA account. Maybe they took a lot of money out back in the financial crisis in 08 and 09, or maybe just never had an IRA account. Some real estate investors, especially who have large rental portfolios, there's no reason for them to have an IRA, or maybe they never had earned income to contribute to an IRA. So even with a small amount of money, you can quickly, organically grow that account, so then you can move on to a buy and hold or a buy, fix and sell, et cetera, et cetera. Buying properties on option with Equity Trust Company, no problem. We get a copy of the purchase contract. Wendy, I'm sure you've done them before in your IRA account. You say, Equity Trust Company, I need a check for $100 for the consideration money. We send it out. And then when you sign that contract, you're going to send copies of all the documents to Equity Trust and notify us that a check should be arriving or a wire transfer should be arriving from the optionor or from the title company for closing.
They can make it real simple for you to, do these deals through them. All you need to do is call them and ask them, hey, I've got this deal I'm working on. how do I best structure it, or what do you need from me so I can get the money from you? Because mostly what you're going to need from them is their signature on some of the docs. Some of them you're going to sign. Just work with them. They'll tell you what you sign and what they sign. They make it real easy for you, and especially for getting the checks and stuff. If you need it overnighted, if 2 days is good enough. I mean, there's different plans that they have for you. So
Did you go through
definitely
the
talk to them.
sandwich lease option yet? You did go through the
Oh
sandwich
yeah,
lease
that's what I've
option?
been working on today.
I love seeing deals, sandwich lease option deals and self-directed IRAs. You know, especially with a small amount of money in it's like a CISA account, only $2,000,
Yeah.
Roth IRA. Maybe you only want to put 500 or $1,000 in the account to get it going. You can quickly start putting deals in that IRA account and growing it organically. One last thing,
why pay for college outside of the IRA? Why not pay for it in the IRA if you're going to already have to pay for it anyways, right? Think about that. So
And the other option is if, let's say, for example, you're going to buy a $50,000 property and you only have $25,000 in your IRA or other investment account, and then you have $25,000 in discretionary funds or personal funds. You can actually go in as tenants in common with your IRA and with your personal money, or we're probably going to use like an LLC or an S corporation, right? For asset protection
You can
purposes,
partner with
tax
yourself.
purposes. Right, you can partner with yourself. So in this scenario, I buy this $50,000 property. At closing, I send $25,000 from my IRA. I send $25,000 personally. On title, it's going to say Equity Trust Company, Custodian, FBO, my name, IRA, undivided interest, the percentage, in this case 50%, and then my S corporation, 50% undivided interest.
and it doesn't have to be 50-50. It could be 30-70,
Right.
whatever portion you put in, right?
Right, and you can
Has
partner.
to stay whatever portions you put in, though.
Correct. All expenses must be paid in accordance with the ownership interest, and all profits from the rental or sale of the property must flow back in accordance with that ownership interest. So if I'm in it, let's say I buy it again for $50,000, I put 10 into it, I'm in it for 60. $5,000 of that $10,000 in repairs must come from my IRA. The other $5,000 must come from my S corporation or my business or me personally. And then let's say I sell the property for $100,000, so I make a $40,000 profit. $20,000 goes back to the IRA, which is exempt from tax. I don't even claim that. That just goes in my IRA account. The other $20,000 goes to me personally. So what I've done is simultaneously accumulated wealth in my IRA as well as for my business, and I have those retained earnings so I can redeploy that into other investment opportunities. And if you look at it from an accounting standpoint or a tax standpoint, I've reduced my taxable income by 50%. So when you are looking at various real estate transactions and you know that you're going to make maybe $40,000, $50,000 in profit on one deal, let's say it's less than 12 months, so you're going to be subject to short-term capital gains tax, that can be ideal for the IRA environment. So as long as it's suitable for your particular portfolio. Okay, so all different types of techniques and strategies. And Wendy, I don't want to take up too much time here. I could go on and on and on and talk. And if anyone's ever come out and seen any of our workshops or been to any of our conferences, you'll know that we can spend days on various strategies and techniques with self-directed IRAs. But I'm very enthusiastic about this weekend and look forward to learning as well because I'm from Cleveland and I can buy houses for $5,000 or $10,000. And what Wendy's talking about here is conducive for an IRA environment, again, especially for those that only have a small amount of money in their account. And systematically, it's very simple to do with the IRA account. An Equity Trust Company as your custodian, we essentially operate as your facilitator. So we don't invest your funds. We don't take the money and go out and buy properties on our own. You move the account into an Equity Trust IRA, and then you would say, Equity Trust, I need a $100 check for option money. Here's a copy of the option contract, and then Equity Trust will facilitate the check being sent out. That way you can enter into that contract, and if you assign that contract, again, all of the income that you derive from that assignment fee goes back into the IRA tax-free.
Excellent. It's just such a powerful way. I mean, we know we can't really rely on companies for your retirement, or you've got to set up your own, and this is a great way to do it for yourself, especially you young people.
The
All
Roth
right.
IRA account.
All right.
Oh,
Hey,
yeah,
thanks, John. Thank you so much.
You're
Can you guys give him a
welcome.
big round of applause? All right. Thank you.